world of annuities, it seems like the last 10 years or more have been all about income. Lifetime income riders, GLWBs, GMIBs, and so forth. Today, though, we're going to learn about an annuity designed for accumulation, and I think you're going to like it. Not every prospect and client needs a lifetime income rider, but I do believe everyone needs a solid platform for savings and growth, one with low costs and access to a wide array of sub-accounts. And that's what our good friends from Protective Life will be speaking about today. At this time, I'd like to turn the presentation over to Mike Malone, our longtime friend and partner. Mike?
Thanks, Alan. This is Mike Malone. Thanks, everybody, for attending. So we've been working with Core Group for a number of years now, and they have organized this meeting for us to go over our investor series. So appreciate everyone taking time out of their day to meet with us and hear about this product. It is, I think, will solve some problems for you, and it's a good solution for a number of items for your customers. So a little bit quickly about Protective Life before I hand it off to Noah Farborough, who will be doing the actual presentation. Protective Life, we're A+ rated. We've been in business since 1907, and we've been in the variable annuity business since 1996. We've been working with Core Group for a number of years. They sell our life products, and on the annuity side, we've worked with them for almost 10 years now. So we're happy to have you join us. We hope we'll be able to provide some good information for you. And Noah, if you're ready, you're welcome to go ahead and start.
Excellent. Hopefully you can hear me okay. I sincerely appreciate the opportunity to be on this call as well. And I am Noah Farborough. I'm the Regional Director for Protective here in the Mid-Atlantic area. And hopefully everybody can see on their screen a brochure called Protective Variable Annuity Investor Series. And as your colleague at the beginning of the call mentioned, this is designed as a low-cost investment-only variable annuity. And when I say low cost, I mean 1% internal expense for the M&E and the A. So it hovers right in there with your managed money type program. And that's how I position this. I position this as a managed money variable annuity. And what's nice about it is you can pick or choose any funds you like within our lineup. There are a lot to choose from. And so, Mike, if you could open up that brochure to the fund lineup. Let's go one more page there, a couple more pages in, actually. You'll see a bunch of different funds to choose from. And what excited the Core Group and has been a wildly successful Protective Life as well is what we call our Allocation Adjustment program. And Mike, if you can open up the brochure with all the different funds.
Yeah, I have.
Yes or no.
Oh, you have that showing? See it? Yes, I do.
Okay, I still see the product specification page.
Okay.
On my screen here.
I'm seeing page 5 with the.
You're seeing page 5.
Yes.
Okay. Then I'm just going to go off by memory here. So if you're looking at the funds in the lineup, you'll see a bunch of different funds in there, and you'll see a yes or a no. There we go, Mike. It just showed up. You'll see a yes or a no next to each fund. Yes means it will participate in our program called Allocation Adjustment. And what Allocation Adjustment does is it monitors the 12-month simple moving average for each fund, for each client, each month. And if a fund falls below a client's individual moving average, Protective Life actually reaches into that particular fund and sells it on behalf of your client. And because this is happening inside a variable annuity contract, it doesn't create any taxable gain to the client. And eventually, as funds turn around and hit the bottom and they start to come back up, Protective continues to monitor them, and eventually a fund will come back up and it will climb through its 12-month moving average. And when that happens, Protective Life goes into that particular fund, again, for that particular client, and we buy back in. So what we're doing is we're selling when it's high and buying back in while it's low for each individual client according to their specific average of whatever fund they own. And any fund with a yes next to it will participate in that program, and any fund with a no next to it doesn't need to. Now, there are some funds that have been more popular than others in this particular program, and as Mike has highlighted on the screen, the most popular fund in this particular program is the Fidelity VIP Index 500. And as a wholesaler, I never thought I would be out wholesaling an S&P 500 index fund. But it turns out this fund happens to work quite well within the program. And one of the reasons it works quite well is, number one, it's an index fund, which traditionally are unmanaged. And all that we are doing is we're following the average of that particular fund. The other thing most advisors like about that fund is you're giving your client access to 500 of the most well-capitalized companies in the country. And we're doing that for only 35 basis points. So with the 1% M&E and the 35 basis points on an S&P 500 index fund, we're now all in at 1.35 for a managed money VA that offers a downside protection with a built-in buy and sell strategy. So I went kind of fast there. We're offering a managed money VA at a 1.35 internal expense that offers a built-in buy and sell strategy, and all that we're doing is monitoring the 12-month simple moving average. So we're following the trend. So the next question is, all right, we get the concept. You're trying to sell while it's still high and buy back in while it's low. And you're monitoring this each month for each client. The next question is, does it work? So Mike, if you're able to pull up a sample hypothetical.
Okay.
There we go.
A little slow, but I've pulled it up. There you go.
There we go. So what we did here is we ran a sample hypothetical, and we used the Fidelity S&P 500 fund. So we ran a 60-year-old client, put $100,000 in, excuse me, and we started it on December 31st. And the reason we did that is I like to start funds at the beginning of a year. That's when I like to start hypotheticals, because at the beginning of the year it gives you a true year-over-year representation. It always kind of drove me crazy when I was an advisor, when a wholesaler would come in and show me the best fund over the coolest time period, and I could never really make it look like that again. So I always said if I ever went into wholesaling, which is what I'm doing now, I would show a true year-over-year representation and start the hypo on December 31st. So that's why you see it started there. And then I went back as far as I could. So we started in 1995, and we ran it through the end of 2016. Mike, if you can go to the next page here, and let's take a look at how it looks. Perfect. So the nice thing about Protective Life is when we run a hypothetical, we show you how the fund would have looked with, and again without, our program. And the name of the program is called Allocation Adjustment. So here you see with and without allocation adjustment. And all this is the S&P 500 in our particular product. So we started out with $100,000, and let's just start out looking right at the bottom, the average annualized net rate of return. So just right at the bottom, you see a difference from 8.84% to 6.6%. Now, as most of you know on this phone, many of our clients don't necessarily understand how percentages work, but they understand the account value in their particular contract. So take a look at the difference in account value. We're looking at a difference of 592 versus 387. That's a major account value difference. But that's just over the long term. If we go back and look at some of the tough years, like 2000, 2001, 2002, without allocation adjustment, you see a bunch of big negatives there. I see negative 1311 in 2000, negative 10.87 and negative 23.39. So sequence of return risk plays in heavily with these types of contracts. If you have negative rates of return at the beginning of an investment, now you've got a sequence of return risk, which is very difficult to bounce back from. But if you take a look at our particular contract with allocation adjustment in those same years, you see negative 2.35, positive 2.58, and positive 0.26. And the account values are significantly higher. Now flip down to 2008. You see a difference with our product at 1.55 versus without our product at negative 38. So the goal of this is not necessarily to try and set the world on fire with rate of return. The goal on this is to try and reduce the downside from the start. And we may not be perfect at the top, and we may not be perfect at the bottom, but we're monitoring each month, each client for each fund. So a lot of advisors will ask me, hey, Noah, I understand this product pretty well. What's the downside? And I like to say the downside is actually that you might miss some of the upside. So if you take a look at 2009, with our product, you would have been up 12.85. Without our product, you would have been up 24.79. But keep in mind, if you don't fall into a hole in 2008, you don't need to dig your way out in 2009. And that's evident just by looking at the account value difference. So we come right out in front of it and say, listen, you may miss some of the upside, but that's okay for the client that buys this because their goal is to try and reduce volatility on the downside. And I'm going to pause there real quickly. I'm not sure if we have an open phone line or not, just to see if anyone has any questions on this particular page.
I'm not sure the phone line is open, though.
Okay. Then, Mike, let's just go to the green and red bar graph if we can.
Okay, one moment, please.
There we go. One of my favorite pages in our particular hypothetical is where green turns to red is where we would have shifted your client from the percent in the allocation that they selected, in this case the Fidelity Fund, to a cash position, which in our scenario is an Oppenheimer money market. Well, I like to say when green turns to red is where we would have made happy clients. Over the long term, 75% of the time your client was invested in the fund they selected. But in the short term, that 25% is where we came in and would have shifted to cash. So investment-only VAs are not all that unique in the marketplace. There's a lot of companies with it. But Protective Life is the only company with this particular process to try and reduce volatility inside the contract. One more thing that really separates us is the fact that we can offer an additional death benefit inside our investment-only VA. So for an extra 20 basis points, Protective Life can offer a return of purchase death benefit. And really what that means is if you think of the standard death benefit on most annuities, you get a return of purchase. But that's not the case with Protective. Our standard death benefit is just account value. But for an extra 20 basis points, we can add a return of purchase death benefit on there. And just a numerical example, if you have that return of purchase death benefit, you put in $100,000 and your client walks outside, gets hit by a bus, and dies. And the same day, the market crashes and their account value goes down to 80. Their loved ones would receive the full 100,000. And that's how the return of purchase death benefit works. So that is certainly a reason to offer an annuity, especially one inside an IRA. We generally don't think of an annuity offering any additional tax benefit if it's an IRA, which is true. So we've got to come up with other reasons to offer an annuity inside an IRA. And the Allocation Adjustment Program, the death benefit, and the low cost are three different reasons which might justify why an annuity might make sense for a managed money program. So are we able to open up the phone line to see if anyone has any questions?
Yeah, I'm going to hand control back over to Alan so he can manage the audio.
Okay, great.
There you go, Alan. You should have it.
Are you there, Alan?
I am here, but I can't find the spot to turn everything back on here, Mike. I apologize.
I'm unmuting the lines now, so if you guys have questions, go ahead and type in. Most lines are unmuted.
So in the meantime, one of the things that I would ask you to do is I went through this presentation relatively quickly. I would just ask that if you have questions, you can reach out to Mike, and we can get you in front of the correct wholesaler. We actually have 50 wholesalers with Protective across the country, and there are two different positions. There's the regional director, and the regional director's responsibility is to be the team leader on behalf of their territory. And we also have an account development manager who's out working to develop new relationships with advisors that may not already be working with us. So we have a full team of wholesalers dedicated to support you out in the country.
No, this is Laura. We had a couple written questions. Someone asked, is it a 12 monthly or weekly? I don't know if that's
a good question. So allocation adjustment is a 12-month simple moving average. So each month we pick up a new month and then we lose the oldest one. So it's a moving average, and we purposely use a moving average in order to avoid excessive trading inside the contract. But we also have funds that follow a similar process. They're not with allocation adjustment. They're managed by Janus, and those follow those actually shift in and out of cash on a weekly basis. So we have two different ways to try and reduce risk inside our contract. You could do monthly, or you could do weekly, whatever makes most sense to you.
okay. And then there was another question: is this different than the program with the 25% move and the 2% buffer?
Yes, it is. So that's what I was just referring to. So allocation adjustment is the 12-month simple moving average. The models that are managed by Janus go 25% to cash each week if they fall below a 2% buffer. So we have two different methods to reduce risk. One is allocation adjustment.
All right. Well, it sounds like we lost Noah. Noah, if you're still there, we lost your audio. Alan, are you there?
Laura, can you hear Mike?
Yeah, I can hear you, Mike.
Okay. So to finish Noah's thought, he was describing, the question was about the 25% movement and the 2% buffer zone. That is in a proprietary fund that we use within the product. It's sort of similar to the program that we were discussing earlier, the allocation adjustment. The allocation adjustment looks monthly at that 12-month simple moving average, and then almost a variation of that are these funds that we have, the protective dynamic funds. And inside of those, on a weekly basis, it has a similar process where it looks at a 252-day simple moving average. It compares, they have indicators that will help them decide if they're going to move in or out of certain asset classes. The 2% buffer is to prevent too much in and out within the fund itself. It's weekly. They look at the movements. If they do make a movement, it's 25% of the value, and so that way you kind of smooth out the in and out of the market. And then the 2%, over 70% of all changes in the S&P 500 are less than 2%. And so this is a way to make sure that when we are moving assets in and out of the asset classes, it's for a more significant move, and another way to smooth out the action of those funds.
Great. Thank you, Mike. Well, I think with that, we will conclude the call. If you have any questions, please direct them to your core relationship manager. If you don't know who that is, or if you'd like to speak directly to Alan Bradley, our Director of Annuities, our phone number is 800-991-6711. Again, 800-991-6711, or you can email annuitydesign@coregroupusa.com. Thank you, Mike. Thank you, Noah. Thank you, all the participants, and we look forward to talking to you guys soon.
Thank you very much.
Bye.